in the chat room? Okay, thanks. Yes, thanks for your reply. And okay, so it's my first seminar after the new year, right? So still happy new year to all of you. And last time I conduct the session for the 6th of the 8-course series for technical analysis, right? So I mentioned that, wow, that's the last session before the new year. And today is the first session after the new year. And welcome back. Welcome back to my series about these 8 courses of technical analysis. And it's already the 7th today, right? It's already the 7th of this series. And next Tuesday will be the last. The last one is about indicator application. And today it is about the application of a moving average, right? So means this series will end soon, right? It will come to an end soon. And after it is finished, maybe we will switch to the software application. So maybe the Tuesday after next Tuesday, we will begin from the first session for application of software. Okay. Still, if you have missed the previous sessions for this 8-course series about technical analysis, no worries, because in future we will come back to talk about this series again. And because after joining Homely, right? So 2 sessions or 2 types of sessions are very important. One type is about the theory and knowledge, which is the 8 courses of technical analysis. The other type of course, which is also very important, is the 8 courses of software application. So this round, we learn about the knowledge and the theory. So after it, we switch to software application, because software application also very important. And after that, we will come back again maybe to the knowledge series again. Okay, so if you missed the previous ones, no worry. In future, we'll be back. Okay, so for today, we include 3 parts for today. First part, we talk about some basics about moving average, and also included in the first part, I will talk a bit about the market performance, right? After all, it's the new year, right? So new year, especially the first trading day for US, big drop. And members and a lot of investors are concerned about the market performance, let's say for short term or maybe for the whole year. Okay, so later we'll talk about the performance, market performance first, before we talk about the basics about moving average. And the second part, I will share about the basic application of the moving average. The third part is about advanced application of moving average. Okay, so let's check the market first. Okay, so for first trading day for US market, we see this long bearish candle for Nasdaq. It dropped by more than 1%. Last night for Nasdaq, it is considered as a very forceful drop, right? But is it really a very bearish signal for medium term to long term? So currently, if we check the golden section here, right? So we realize that last night, the low price, it touched the 80.9% of the golden section, which is currently short-term strong support. This is short-term strong support. Meanwhile, we have the yellow Tai Chi signal, right? The yellow Tai Chi signal roughly at the same level. So for short term, this should be a strong support. And if we say in near future, the level here can hold, the price will never drop below this support level here, means it's just a very short-term correction for Nasdaq. Okay, so this is Nasdaq, right? Means the price gets support here, maybe will turn upward again. Okay, but if in near future the price even drop below this level, means it's a more serious correction, a bigger scale correction, more than just a short-term correction, right? And the next target, we will look at the 61.8% of the golden section. The value is around 12,150 points. Okay, so if really the correction can touch the 61.8% level, means what? It's good chance to consider buy again if the price turn upward again, right? Because we already mentioned, generally speaking, the big trend for 2021 would be upward. It would be bullish. Generally speaking, the direction would be bullish for long term, right? So means after significant correction, bigger correction, then the price turn upward again. That's the best entry point again. Because no big correction, then the price is high. At a high level, we buy, our cost will be quite high. But if after a big correction, then the cost will be lower. Our buy point would be lower. Of course, the precondition is we are in the medium term to long term uptrend. Yes, that is the precondition. So after the correction, here, if it's a bigger one, it's not necessarily a bad thing. It may be a good thing. So of course, if this 80.9% level can hold, the price cannot even drop below this level, means it's just a very short-term correction here. No worries. Okay. So this is about Nasdaq. And if you check the other two major indexes for US, S&P 500 and Dow Jones, you realize the pattern roughly the same because indexes of the same market verify each other, right? So this is what we have learned in the first or second session of this 8-course series about technical analysis, right? So that's the Dow theory. Indexes verify each other. So US market, the three indexes, they verify each other. So you see similarly, if you check the golden section for S&P 500, last night the price also stopped dropping further at the 80.9% level. Support is around 3,666 points. The level can hold. It's just a short-term correction. Maybe in future it would turn upward again. And if it drop below, then next target 61.8%, 3,566. Okay. And then for Dow Jones, yes, Dow Jones last night also long lower shadow touched the 80.9% level around 29,790. Okay, next target 61.8%. But as long as the short-term support level can hold, we don't need to worry too much. Okay, and because the US market has very big influence on the other markets, our Singapore and other Southeast Asia markets like Hong Kong and KOCI, right? A lot of our members trade these markets. Then today, one of my members asked me, is the turning point based on our 2021 calendar, right? So 5th January, today is the turning point. And members ask me, well, does this turning point mean turn upward or turn downward? Okay, so here, let me spend just 1 or 2 minutes to explain to you briefly how to read this calendar, okay? And if you you haven't yet got this calendar, right? So you better go to the 3 branches to collect the calendar. Okay, so if you already got it, maybe you don't know how to read it, right? So just share with you, it's very easy to read this calendar. We see all these symbols, right? So it doesn't matter what symbol it is. You only need to know that if one certain day got a symbol, whatever symbol it is, means it's a significant turning point. So turning points, we have a different significance. Some turning points might be, let's say after that, it would be a very big scale uptrend or downtrend, turn upward, turn downward for a long time, or for quite a long time, or for, let's say, for medium term. That's very significant turning points, right? But some turning points, maybe just a short-term turning. After that, the price turn downward or turn upward a bit, and then maybe would quickly turn again, right? So means these turning points, some of these turning points may be significant one, some may be less significant. And also for the direction, right? So turning points, it has several meanings. The first meaning is previously it's down, right? So when we on that day, the turning point day, it will turn direction. Previously down, then it turn upward. That's turn upward, change direction. Or previously it's upward, then when we are on that day, it will turn downward. It's easy to understand the first meaning of turning point. But turning point, it also has another meaning, which is speed up. Means maybe previously it dropped, right? It keeps dropping all the time, and then it's the turning point day. Maybe after that day, the drop would change speed. Previously drop slowly, then after that day may drop sharply. This is also called turning point. Okay, in the same logic, if previously it's going up slowly, then when it's the turning point day, maybe after that day, it would speed up, go up at a faster speed. Okay, so turning point, it doesn't only mean direction change. Also, it might mean speed up. Okay, that's about the meaning of turning points. And about the direction, before we are very close to that date, we don't know the direction, whether or not it will be up, whether it would be up or would be down, or it would speed up or would speed up. We don't know until we are close to that day, or we already reached that day. Okay, so for now, let's say we already reached the turning point day, right? Then what it means for the current turning point day, May 5th January turning point, right? So just now we already checked the performance for US markets. We have mentioned that all the 3 indexes for US touch the short-term strong support. If the level can hold here, means it would turn upward. But if, let's say tonight or in near future, the price drop below the level, the significant levels we mentioned, then means it would turn downward, means speed up. Previously, it dropped maybe slowly. After that, maybe it would drop at a faster speed. Okay, so if US market, it can hold, the short-term support levels can hold, then for the other markets, most likely they would follow, right? But if for US market, these support levels cannot hold, a drop maybe at a faster speed in near future, then other markets also would follow. Means what? If you check the performance for STI, for Hang Seng, for KOCI, you also will realize that these indexes reach significant support level. For example, this is our STI, right? So for STI, now we also see the price touch the 80.5% support level based on the golden section, right? So means If US market hold, then Singapore market, this level can hold, then it will turn upward, right? Maybe in future would try to challenge the previous high again. But if US drop below the support, also the 80.9% for the three major indexes of US, then most probably our STI also would turn downward. Break down the support, maybe drop further. Next, strong support is 61.8%, which is 2,728 points. Okay, so this is for our SDI. Then you continue to check KOCI. KOCI, these two levels I have talked a lot previously, right? So currently the drop already touched the strongest support for KOCI. This is based on chip distribution. Then you see the longest blue bar here, means the strongest support here. So we see today, right? So the price seems like stop dropping further because this is the strongest support. If the price drop below this level, then it's really a bearish signal for KOCI. But I think this is the strongest support. The support is very strong here. Maybe the level can hold. Yes, maybe can hold. Maybe the price might just sideways there around the strongest support here. And yes, but let's say if the price really drop below this level, and then below this, relatively speaking, also would provide some support here, right? So the final defense line, I think, would be here, right? This blue bar. If it drop below, then I believe for QCI already turn, at least for medium term, turn to bearish again. It will be very difficult next time for the price to break up the level here again, because you see previously the price has tried for previously, you see 1, 2, 3, 4, 5 times to break up the resistance here. Finally, this time it break up, right? So next time drop to this level, most likely the strong support here, the level can hold. That's most likely. But if it cannot hold, means it's quite bearish for QCI. Next time, it will try to break up the level again, but it will be very strong resistance. Hope the level can hold, and I think the probability is quite high that the level here can hold. Okay, so if this level can hold here and the price is turn upward again, next time the price will try to challenge the previous high again, which is the second longest blue bar of chip distribution, right? Yes, if next time the price break up, that will be quite good for KOCI, because above we see the resistance quite weak. With weak resistance, the rally can be smooth rallies, okay? Can go up faster, okay? So this is for QCI. Also, we need to check how the US market would fare, right? And for QCI, okay? And then for Hang Seng Index, we see recent several days it has been quite bullish, right? The strongest support, the blue bar here, the level hold, and then recently going up all the time. And the current price for today, I think it's roughly reached this blue bar. Yes, it roughly reached this blue bar, right? And this will be some weak resistance. But above, a stronger resistance level should be this blue bar, right? This blue bar, the top, the value is 28,622 points. If in near future Hang Seng Index can continue going up, reach this level, maybe would be stronger resistance for the turn downward again, or we should wait and see whether it can break up the resistance level here. Okay, so this is for Hang Seng Index. Okay, so let's continue. I think we already talked about all the major indexes, right? So then we should go to learn about moving average. So firstly, we need to know some basics about moving average. What is a moving average? Moving average, so it is a succession of averages, actually average prices, derived from successive segments of a series of closing price, right? Okay, so moving average is calculated based on closing price, and it's a it is based on successive segments, right? Successive segments of series of closing price. And the feature here is constant size. What it means, constant size and overlapping. Let's check the formula here, how it is calculated. For example, you check X. X here is the number of the trading days chosen as the parameter. Okay, so we say constant size. Actually, this constant size means the parameter for X. So we always say for moving average, we have 10 days moving average, we have 20 days moving average, 6 days moving average, 120 days moving average, right? So these are the parameter for the moving average, and this will be the constant size. How many days moving average, right? And if you check the formula here, you realize that it is overlapping. For example, okay, let's check the formula. Let's say X, if we take the X as 10, means it's 10 days moving average, right? So how we calculate 10 days moving average? Because it's a succession of average prices, right? And it's close price. So if the parameter here is 10, MA 10 equals to close the first 10 day, we got 10 day, altogether 10 day, right? First day, second day until the 10th day closing price. We get the sum, right? We get the sum, then divided by 10, right? Because the constant size is 10, right? Divided by 10. This is the value we get. That's the value for the 10th day. For the 10th day, right? And then how about the 11th day? The value for the 11th day is it's based on the second day until the 11th day's closing price. We get a sum and also divided by 10. So that value we get is the 11th day's value. And then if you want to continue to calculate the 12th day's value, then it should be C3 until C12, right? C3 until T12, and then you get a sum divided by 10. So it keeps moving, it overlap, right? So this is how we get these values. After we get the values for the 10th day, 11th day, 13th day's value, we connect these values. So that is a succession of values, average prices. For example, let me show you with a concrete example. MZH, this is a superstar Singapore stock, nano film, right? Okay, so for nano film, how do we get a moving average in the Homilychart software? So we got CHN, we have the moving average group 1, right? So this is MA1. Why Okay. So we get the moving average group 1. Currently, if you check the value here, right, you realize that the values already set, but we can change, right? And now you cannot see the moving average. Why? Because this is a sub-new share, right? Sorry. I see the problem. I didn't share you the software. Sorry about that. I always got this problem. Forget to switch. Okay, yes, now we are checking the chart for nanofilm. This is the superstar, right? Superstar Singapore sub-new share. IPO not a long time ago, just November last year. Okay, so where do we get the moving average? CHN, right? Then CHN we get moving average group 1. This is MA1, right? In the software, we get several groups of moving average. If you go to IND, then you see MAG 1, 2, 3, 4, right? So actually, we don't need to use so many groups. We just use one group, and we can change the parameters. So one group is good enough. So usually I don't check the other moving average groups. I just check moving average group 1. So I don't use it under IND. I just check it under CHM, MA1, right? But after I click MA1, you don't see the moving average lines, right? Because if you check the value here, can you see MAG1 after that, the red color, the parameter is 120 days, 200 days, and 325 days, and 21 days. Because the parameter is quite the big one, and this is a sub-new share. That's why you cannot see the moving average lines. So the parameters for the moving average group 1 already been set by myself. And you can set also by yourself. How to do it? You go to the setting, right? This is the setting. You go to setting, then on the right side, you see moving average group 1, 2, 3, 4, right? So if you double click moving average group 1, then you see moving average group 1 appear in the middle, right? If you click 2, then moving average group 2 appear in the middle. So we just need moving average group 1. Okay, so after that, you see we have 4 colors of moving average. You can set 4 moving average altogether in this moving average group 1. And this is where you change the parameter. For example, if you want 4 moving average lines, then you just check all the boxes before display. But if you don't want so many, for example, you just want one moving average, you can just uncheck. I just remain the white color here. Okay, so this is to decide how many moving average to display. Currently, I just want 1, so I uncheck the rest 3. Then I also can change the number. This is the parameter. Just now, I was talking about 10 days moving average, right? So taking 10 days moving average as an example, I will change the parameter for the white color here, the white line here as 10, and display and conceal all the other 3 colors. Okay, I click save, and I click OK. Then you can see the 10 days moving average here, right? Okay, so now after that, you will realize that the first 1, 2, 3, 4, 5, 6, 7, 8, 9, the first 9 days, we don't have the white line, right? Why we don't have the white line, the 10 days moving average for the first 9 days? Because currently we are checking 10 days moving average. 9 days, it doesn't, the number is not enough. We need at least 10 days to calculate 10 days moving average, right? Because the parameter is 10, 9 days, we don't have enough amount. So that's why the first 9 days, you don't see the white line. And then the 10th day, this is the first day we get a value for 10 days moving average, right? So how do we get the value for the 10th day, which is 12th November? We we try to calculate the sum of the close price for the first day, second day, third day until the 10th day. We get the sum, the close price, right? The sum of the close price, then divided by our parameter 10. So the value here we get, this is the value for the 10th day. And the 11th day, this is the 11th day, right? For the 11th day, how we get a value here? How we get a value here? Sorry. How we get a value? How we get a value here and value here? For the 11th day, we will drop the close price of the first day. We begin from the second day, right? So we just try to calculate the sum of the closing price for the second day until the 11th day. And then divided by 10, we get a value for the 11th day. And then for the following day, for the 13th day, how we get a value for the moving average on the 13th day? We drop the value, the close price of the first and the second day, and then we begin from the third day, and then until the 13th day, right? So it's also 10 days, right? So the parameter is fixed, just the 10 days. Every time we calculate the average of the close price for 10 days. But every time we drop the old close prices and we add the new is the close price. So it keeps moving. That's why it is called moving average. Keeps moving, and it's the average price, moving average, right? And then it overlap. It will, every time you drop one and you add a new one, but there will be some close price. They are calculated every time, overlap, right? Okay, so this is how we get the moving average. Okay, this is the definition for moving average. Okay, and let's continue. This is the definition. For those members who don't have basics about technical analysis, maybe you don't know how moving average is calculated, or maybe you know moving average, but you really don't know that deep about this indicator. So I just want to explain to you so you can understand deeper. Okay, so let's switch back to the slide. Just now we have talked about the definition for moving average, how it is calculated, right? Okay, then let's check some key notes about moving average. So moving average, it reflects the general performance of the price movement. If the moving average line is upward, means it's uptrend. If it's downward, means it's downtrend. If moving average going flat, means it's sideways, right? Of course, the scale of the trend tracked by moving average is determined by the denominator. Just now we say 10 days moving average, the sum of the close price divided by 10. But if it's 20 days, 60 days, or 240 days moving average, then the denominator of the formula is these numbers. The parameter of the moving average. If it's a big parameter, means you're checking a bigger trend, long-term trend. But if you are using a shorter, a smaller number as the parameter, you are checking a shorter term. Okay. And usually we have a basic model for the parameters for moving average. 5 and 10 days short term, right? Short term moving average, and 26 you can say it's medium term, and then 100 you can say medium term to long term, and some people also can regard it as long term moving average, right? And 240 days. That's long term, or some people may feel it's super long term, right? But there is no very, let's say, clear boundary between short term, medium term, or long term. Just roughly, we know it's a short term or medium term or long term, right? Some ambiguity here. Okay, so this is the basic model. And sometimes people also prefer the Fibonacci numbers as the parameter for moving average. So we know the Fibonacci numbers, so 5, 13, 34, 55, 89, 144, 233, right? So each number is the sum of the previous two numbers. For example, 13 equals to 5 plus 34 equals to 5 plus 13, and 55 equals to 13 plus 34, right? So this is called the Fibonacci number series. So Fibonacci numbers are quite magical. So our golden section and our fifth time zone, these two indicators are based on the Fibonacci number. And also if you have learned about the wave theory, right? So Elliot's wave theory also related with Fibonacci numbers. So it's magical numbers for stock markets. And some people feel that the Fibonacci numbers taken as the parameter for moving average also quite useful. You can try that. Okay. So of course, the best parameter for individual stocks or for different indexes might be different from the two models above. So it's just like we have free size for some clothes, right? So free size maybe roughly average height or average weight person can all wear. But sometimes for some maybe shorter or some very tall persons, they may need special sizes, right? So it's the same for individual stocks. Some maybe these two models can apply, would be already good enough. But for some individual stocks or some indexes, maybe they need special parameter. So how do we find the parameter, the best parameter for the index or for the individual stock? Later I will share with you a method, okay, to find the best parameter. Okay, so parameter is the most important thing for application of a moving average. Okay, so the bigger, of course, the bigger the parameter, the more stable yet more lagging the moving average, because stability and also speed, these two are contradictory to each other. They are like the two different sides of the same coin, right? So here the problem would be how to reconcile the contradiction. On one hand, we want the indicator to be fast enough. On the other hand, I want the indicator to be quite stable. So for moving average, also the same. On one hand, I want to set a parameter so that it's fast enough to tell me the buy and sell points. But on the other hand, I want it to be stable enough so that I can hold as long as possible, right? So how to reconcile the contradiction? This is also key to the application of moving average. Okay, and then the relation between the price and the moving average, and also the relationship between different terms of moving average can provide us trading strategies. Buy points, sell points. Well, should we hold or should we hold the stock, or should we stay sidelined, hold our money? So this can be these strategies can be made based on the relation between price and moving average, or different moving averages, 10 days and 20 days moving average. Yes, later we will talk about the details about this. Okay. Okay, so then it's important to know the characteristics of moving average. Firstly, moving average, it tracks the trend of price movement, and at the same time, it smooths out the noise of daily fluctuation. For example, this white line here for JD.com, you check the value here. The parameter is 50. Means this is 50 days moving average here, right? And then you see that when the price try to break up the white lines of the moving average, 50 days moving average here. So this is some sort of resistance, but if the price successfully break up, it become support, right? Support. And then after that, you see a correction here. But the correction touch the 50 days moving average, then turn upward again. So if you check the moving average, 50 days moving average, for medium term to long term trading, you don't have to bother to sell here, right? So this is how it smooths out the daily noise. This is for short term correction here. But for medium term to long term trading, you can ignore it, right? Because it's still above the 50 days moving average. And also for here, the correction for short term here is quite far away from the 50 days moving average, means you can ignore the daily fluctuation here. This is the noise for medium term to long term trading, because it's quite far away from the 50 days moving average. 50 day, you can regard it as the medium term moving average. For some people, maybe can say medium term to long term, okay? Yes, this is the first characteristic of the moving average. It tracks the trend. Generally speaking, the 50 days moving average upward means for medium term to long term, it's uptrend. It tracks the price movement, the trend, and it smooths out the daily fluctuation, the noises of the short-term fluctuations. Okay, and then the second characteristic of moving average is stability. So stability is based on the first characteristic we mentioned just now. Yeah, it tracks the trend, right, and it smooths out the daily fluctuation, the noises, so it's stable. That's stability. And of course, just now we have mentioned the other side, or contrary to stability, opposite to stability would be hysteresis. These two are contradictory to each other. So hysteresis means it will be lagging. Moving average always lag behind the price movement, and the bigger the parameter, the value of the parameter, the more stagnant it is. So 120 days moving average will be much more slower than 20 days moving average. It's easy to understand, right? It's, of course, it's more stable. For long term, you check 120 days moving average, it's quite stable, but it's quite slow. For short-term trading, you don't want to check the 120 days moving average, right? That's for long-term or super long-term even. Okay, so this is the third characteristic of moving average. For example, this is also the same stock, JD.com, right? 50 days moving average, the white line, and then 21 days moving average for the yellow. The yellow one is the shorter term, the white one is the longer term. And if you check the yellow line, the sell point would be faster than the white line. If you see the price drop below the yellow line, that's you can sell earlier. Then when the price gap down to be lower than the white line, right? That's why we say the bigger the parameter, the more lagging the moving average. So the 21 days moving average faster than the 50 days. But after all, whichever moving average you check, they are quite stable. For even the 21 day moving average, it managed to support here, 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 and here, right? So finally, it dropped below and tried to break up again, but failed. Drop again, right? Yes, this is the second and the third characteristic of the moving average: stability, stable, and also hysteresis. The bigger the parameter, the more lagging. And of course, based on the chart here, you also will realize that the moving average will be a support or resistance. So when the price drop below the white line and the yellow line, next time it try to rebound, to break up, it will be a resistance. If the price unable to stand above the two lines, then resistance, you see a drop again, right? Because this is resistance. And then you see after the price drop below the two lines here, after the downward gap, the price rebound, try to break up the resistance again, but failed, right? Then you see a drop further. So moving average will also be a support and resistance. Based on the support and resistance of the moving average and effective breakthrough of the moving average, we can decide our buy points, our sell points, either for short term, for medium term, or for long term, depending on how many days moving average it is. Okay. So yes, the first characteristic of the moving average is support and resistance. If the price above, it's support. If the price below, it is a resistance. If price drop below the support, means sell points. If it break up the resistance, then break up the moving average, go up above the moving average, buy point, right? Okay. So, for example, this is Alibaba. The white line here is 44 days moving average here. And you see previously, every time when the price touch or about to touch support. And this is the false breakthrough because the price managed to go back again above the moving average in 3 days, right? Okay, so here, drop below, already more than 3 days, effective downward breakthrough. And then we see the price try to break up again, resistance. And you will realize that for this period, it's in sideways, right? So when it's in sideways, we see the price frequently break up and break down the moving average. So means in sideways area, the moving average also may not be that instructive. You will realize that for many indicators, sideways area is the blind spot. But of course, if you see, sometimes you see the price, it drop to touch, also supports. And when the price try to break up, also resistance, right? Okay, so then when the moving average finally turned downward, and then the price drop below and try to break up again, failed, turn downward again. So resistance, right? And then next time, resistance. Yes, so this is about the moving average acting as the support and resistance. Okay, so that's the basics about moving average. Then let's continue to check about some basic application. How do we buy and sell based on the moving average, right? Okay, so firstly, we mentioned about the support and resistance of the moving average. Of course, we get support at the moving average. We buy, the price drop below the moving average, effectively drop below the moving average, that's sell. And also if it's a downtrend, the price a rebound, touch the moving average resistance, right? Also sell, right? This is the buy and sell based on the moving average support and resistance. Of course, we have the buy and sell based on intersection of two moving averages. Usually we will set two moving averages. One is a shorter term, the other one is a longer term, right? If we see the shorter term moving average upward crosses the longer term moving average, it's called golden cross, right? So golden cross, usually that's the buy points. And then shorter term moving average, if it downward crosses the longer term moving average, it is the dead cross. Dead cross is the sell points. Of course, it's very important to set the proper parameter for the two moving average. So how many days moving average you want to set as the shorter term in moving average, and how many days you set as the longer term moving average. So different stocks, it might be different. So how do we find the proper parameter? So firstly, you can take the basic models I mentioned just now, because it's something like the average standard for which means can be applicable for many cases, for many stocks. Of course, if you come across some special locations, you need to set different parameters. We also have methods. Later, I will share with you how to set a proper moving average. Okay. Okay, so about the golden cross and dead cross, I want to talk about it a bit. Okay, so here, this is for Dow Jones, right? So for Dow Jones, we have the yellow line and the white line. The yellow line here is 5 days moving average. The white line is 13 days moving average. Okay, I only display the two. I have concealed the red line and the blue line here. I didn't display them. I concealed them. Just display the yellow and the white. The parameter, 5 days. The yellow one is the shorter term moving average. 13 is a longer term. Of course, this is a short term to medium term, right? Because 5 is quite short term. It's a quite small number. And 13 also not that big. So it's short term to medium term, short term to medium term. Okay, so here we see the yellow line, shorter term moving average upward across the white line, right? The 13 days moving average, we see this is the golden cross. And then here we see the yellow line downward cross the white line. We see this is the dead cross. Right, so golden cross, this is the buy, dead cross, this is the sell. And in between, we have the price for very short term, get support at the 5 days moving average. And for a longer term, it gets support at the 13 days moving average, right? Okay, so here, the price is in a triangle. It is in a triangle, that's why we see the golden cross and dead cross, and then golden cross again, blind spot, sideways, blind spot for moving average. So when the price, here we have the golden cross again, and the price also break up the triangle. So we need to combine what we have learned previously about the chart pattern. Last session, we have learned triangle, right? That's it. That is a continuation pattern. We combine with the moving average. That's how it works, okay? Effective breakthrough. Okay, so here, and then that cross again, right? Yes, sell points, golden cross again, buy points, and then that cross again. Okay, so that's the first two applications, basic applications about moving average, about the buy and sell based on the support and the resistance of the moving average, and also the golden cross and dead cross of two different moving averages. And the third application, basic application, is about the trading, the 8 trading rules of Granville. So Granville is a famous U.S. Investor. Yes, this guy has created this theory, trading rule about the 8 trading rules. It's called 8 trading rules of Granville. So based on this theory, in uptrend we have 3 buy points and 1 sell points, and in downtrend we have 3 sell points and 1 buy point. So how it works? So this line here, this is the moving average, right? So for Granville, in his theory, he has taken 200 days as the parameter for the moving average. Because for many US stocks, right? So especially those blue chips, it's a super long-term bullish. So usually some US stocks, the parameter you set quite a big one. You can set quite a big parameters for some US stocks like Apple, Amazon, Google, these high-tech giants. If you check the very big picture, super long-term bullish, right? So you check, you make the parameter too small, not that significant, right? So you want to check the long-term performance, you set the parameter bigger. So for Granville, he has set the parameter as 200 days. This is 200 days moving average for Granville's theory, but for different markets, maybe we can have a bit different standards. For example, Singapore stocks. Some stocks you set 200 days moving average. That's too big. Maybe you can change it a bit. 120 days or even shorter. 90 days moving average also can apply the Granville trading rule. And yes, this is the moving average. So parameter, different market might be a bit different. So Granville has taken 200 days. Okay, and then this is the uptrend. Let's say medium term to long term, this is the uptrend. So in the uptrend for medium term to long term, based on the Granville trading rules, we have the first buy point called reversal buy. Reversal buy is when the moving average previously downward, and then it go flat, and then price successfully break up the moving average, reverse from medium term to long term bearish to medium term to long term bullish. Easy to understand, right? Reversal buy. After that, if the price a drop in the uptrend and get support at the uptrend line, it's not uptrend line, it's the moving average. Okay, so this is the normal buy points. Of course, sometimes we see the price a drop below the moving average a bit, but considering the moving average, the direction still down, still upward, and the price also turn upward again, this is also considered as a buy point because it's still uptrend, right? Uptrend, the price most likely would continue going up because it's medium term to long term uptrend. Okay, and then for this is the 3 buy points in the uptrend, and then in the uptrend we got a sell points here. It's called overbought sell points. This is when the price, the rally is too fast, too bullish, so that the price is very far away from the moving average. Then the price easily would begin to drop. So because market already overbought. So if it's overbought and the price very far away from the moving average, then it turned downward. You can see that's a short-term sell points. It's called overbought sell points. Of course, this kind of sell points is for short term, or let's say medium term. It's not for long term. Okay, long term, you need to check the moving average. Finally, change direction from upward to downward, right? And then if a really change direction from upward to downward, you will see the price drop below the moving average, effectively break through, right, the moving average. So also the moving average, you realize it will change from upward to flight. It will change direction from upward to flight. And then if after some rebound, the price unable to break up the moving average, turn downward again, this is the confirmation. Double confirmation, already reversed to a medium term to long term downtrend, right? Bearish. Okay, so this sell point here is called a reversal sell. So when the price effectively drop below the moving average, it's already the reversal sell points. And then if you see the price unable to, after some correction below the moving average and then rebound, unable to break up the moving average, this is the double confirmation. It's already confirmed. It's the real reversal here. This is the initial sign that it's the reversal, and then this is the confirmation. And then here you need to pay attention. The difference between the reversal sell point here and also the normal buy point in the uptrend here, because you see also this point here, the price drop below the moving average, and here also the price drop below the moving average. Then how do we tell the difference between this buy point here in the uptrend and this sell point around the reversal, right? Important thing is you need to check the direction for the moving average. If it's the moving average, the direction still upward, and even it drop below, right, it turn upward again, higher probability is the buy points in the uptrend. But if you see when the price drop below the moving average, the direction already changed to flight or downward, then most likely it's the reversal. It's the reversal. This is how we can tell the difference between the buy point here and the reversal sell point here. Okay, especially if you see the confirmation here, then definitely this is the reversal sell points. All right, so reversal sell. After that, we already entered medium term to long term bearish, right? Then if the price is a rebound in the downtrend, even if the price break up the moving average, if you see a turn downward again, you still need to sell, because the direction for the moving average is still downward. But if you see the moving average already going flight, then the price break up the moving average. That would be the reversal here. We come back to the reversal buy point here. You see? Yes. It's very important to tell the difference here, right? Okay, then sell points. And also if in medium term to long term downtrend, if the price try to rebound, touch or very close to the moving average and then turn downward again, also is the sell points. Also is the sell points. This is the three sell points in the downtrend, medium term to long term downtrend. And in the downtrend, we also have one buy point. It's called oversold buy point. This is when the correction is too sharp in the downtrend and the price would be quite far away from the moving average here, right? So market already oversold. When market oversold, there would be a rebound. If the price very far away from the moving average, then the rebound here might be a forceful one, might give us bigger rising space because the price very far away from the moving average, right? Okay, but this kind of a buy point here is tricky. Why? downtrend, if you're not that experienced, this kind of buy point, you buy, if you cannot sell at a faster speed, if it turn downward again, you might be stuck there. And after you're stuck, because it's downtrend, the price will keep hitting new lows. You will be stuck there deeper and deeper. So downtrend, if you're not a veteran, better not to touch this kind of oversold buy points. If you are experienced, maybe you want to try this kind of bottom catch, but it will be tricky and it requires a lot of trading skills. Maybe you also need to combine with some other indicators to make sure your probability is higher, success rate higher. Okay, so this is the 8 trading rules based on the ground rule theory. So repeat again, uptrend, 3 buy points, 1 sell point. Downtrend, 3 sell points, 1 buy points. The 3 buy point in uptrend, reversal buy, normal buy, normal buy. The 2 normal buy points slightly different. Okay, so sell point in uptrend is overbought sell points. Downtrend, 3 sell points, reversal sell, and normal sell, also 2 different occasions for normal sell points and oversold buy points. Okay, so let's check a concrete example. This is, for example, Java. You see my parameter here, the white line, how many days I have taken? 110 days moving average for Java. And you see the price, it gets support, and then effectively drop below, right? This is the reversal sell. This, you can see this is the normal buy because the price dropped to touch, get support, turn upward again, and then drop slightly below, then still turn upward again. Normal buy in the uptrend, and here is the reversal, and then rebound, cannot even touch the moving average, turn downward again. Confirmation. This is the confirmation. Okay, we already reversed to medium term to long term downtrend here, right? So this point, you see the correction very forcible one, very sharp, market oversold. This is the oversold buy points. Of course, it's very tricky to catch this buy point here because how low is low enough to be oversold? You need to check a lot of other factors to decide. So you see, after this downward gap and this 1 day big drop, maybe for some people it's already oversold. It's already very, very big drop, but the market keep dropping. Then how low is low enough to be oversold, to be considered as the oversold buy points? It's not easy to decide. It really requires experience, okay, and a lot of trading skills. Okay, anyway, so oversold buy and the price touch over, this is the sell points because unable to break up the resistance, right? Turn downward again, so you sell. If you sell the following day immediately, you will be able to avoid the big downward gap, right? Okay, oversold buy again. Also after this sharp correction here, the price very far away from the moving average, right? Okay, then the price even break up the moving average, but a drop below again, still the sell points. Okay, so then also next time, here, sharp correction, oversold buy, resistance, normal sell. And then here, gap up open to break up the moving average and then continue going up. This is the reversal buy. Reversal buy, then overbought sell points when the price is too far away from the moving average after sharp rally, right? And then also overbought sell points. The price still far away from the moving average. After the correction, the price touch support should be the buy points. Drop below the moving average, turn upward again, also should be the buy points. Okay, so here, after sharp rally, also far away from the moving average, overbought sell points. This is how the 8 trading rules of ground will work. And the key is to find the proper parameter for the moving average actually. So how to do it? I will talk about it in the third part. Okay, so firstly, you know how to apply the trading rules. Later, I will share with you how to set the parameter to set the best parameter, okay? Okay, so let's continue to check the last part about the advanced application of a moving average. Okay, so firstly, we want to solve the problem of false breakthrough of moving average because sometimes we see the price drop below the moving average more than 3 days, but in the end, it go back above the moving average in a short time. So it's called false breakthrough, right? So how can we regard some false breakthrough? That is a problem we want to solve. If you really like a moving average very much, maybe this is a question or problem you are concerned with the most, right? Okay, so I have provided you several solutions. You can, this is just some, let's say some directions I'm showing you. You can try to fill in a lot of details or figure out some answers yourself. Maybe your answer might be slightly different than mine. Okay, so this is my answer for this question. Maybe my answer can provide you can shed some light for you to find your own answer to the question. Okay, so my solution, first solution is you can set 2 moving averages to form a fluctuation band. What I mean, show you an example. Okay, so firstly, this is Microsoft, right? Super long-term bullish stock. And if you want to check the long-term or even super long-term performance for Microsoft, right? So I have set 2 parameters for super long-term or long-term for Microsoft. One parameter is 325 days. The other is 200 days moving average. Okay, so the yellow line here is the 200 days moving average. The white line here is the 325 days moving average. Okay, so these 2 moving average, they form a fluctuate band. You see that, for example, here, the shorter term moving average, the yellow line can hold for many times, right? So it hold here, but here you see it drop below, but it didn't really turn bearish for long term, right? And then you realize that it touched the 325 days, then turn upward. So this fluctuation band here, if the price is still remain within the band, you still can wait, right? And then finally the price go back above the yellow line again. And then next time, also similar situation happened again. The yellow line hold for once and twice, and then it dropped below, but it didn't really turn to long-term bearish. The 325 days moving average hold again. So this fluctuation band can make sure that for long term you can still hold all the time, unless in future the price really drop below the white line successfully, means downward penetrate the fluctuation band here. Maybe you want to consider sell for super long term or super long term. Yes, I can show you in the real chart. For example, this is Microsoft. My parameter for the two moving averages for long term or super long term is 325 days and 200 days. How do I find these parameters? I will tell you very soon. Okay. Let me switch to the software. Okay, so now we are back at the software, and if I change to Microsoft, now I want to change the parameter for the moving average group 1, right? I go to the setting. I also want the yellow line and the white line because these two colors will be very prominent in under the dark background in the software. So these two lines, I will always pick these two colors, yellow and white. Okay, so I will check the yellow color here. I want to display the yellow line. So I check the box to display it. I change the parameter, yellow line 200 days, okay. The white line 325, right? I change the parameter. I decide the number of moving average lines I want to show. Then I click save. Then I click okay. Now you see two moving averages, 200 days and 325 days. You can check the parameter here. Okay, so for this one, you see in a very long time, this fluctuation band, it can work. Let's say here. Okay, so it work for this period, right? So the fluctuation band, it holds. And here, you see the price, it dropped below the white line, right? But based on the ground rule trading skill, the trading rules, the white line, the direction still upward. And the price turned upward and managed to go back above the two lines. So, means still uptrend. So when confirmed, it's a long-term turn to bearish. When the white line go in flight, the price drop below the white line. And the other thing is you can check the golden cross and dead cross of these two lines, right? Yes. So for example, let me show you. Previously, okay, so for here, maybe here first, okay? Okay. Okay, you will see the band, the fluctuation band also work for this time. It worked for many times in the history. That's why I set these two parameters, okay? And then hold back again and drop below. And you will see that the two lines all go flat. Here, the two lines all go flat, right? They all go flat, and the price tried to rebound to break up the yellow line again, but it didn't really succeed. It dropped below very soon, just in 2 days, below very soon. Next time, try to break up again here, still failed, right? And we see the two lines already go flat. And if you see the price already below the white line here, again, this is the second time, right? So it's different than the previous time when the price dropped below the white line. Let's say, where was it? We were checking just now. Where are the marks? Yeah, here. Okay, so it's different than, okay, so here, it's different than, okay, let me zoom in this part for you to check. So any difference between the price drop below the white line here and here? You see the price also dropped below the white line here and also here a bit and also here, right? Difference is previously the white line direction still upward. And here, when the price dropped below the white line, again, after this time, quickly again, right? So the white line already going flat or slightly downward. So this actually is the time when it's long-term bearish reversal. This is the long-term bearish reversal. Okay, so this is how we can tell the difference between long-term bearish reversal and the buy point in the uptrend when the price also drop below the moving average but can quickly go back above the moving average in the uptrend. That's still the buy point, right? Okay, and then the other thing is you can wait for the dead cross. Of course, the dead cross would happen later than the effective breakthrough of the moving average, right? So you see the effective breakthrough happens here, but the dead cross happens, yes, here, right? So when we have the dead cross, the price already in long-term downtrend for a while, right? So this obviously faster than here, okay? Yes, this is the dead cross because we're checking very long-term performance. The dead cross here would be quite late. We already mentioned lagging, and the golden cross and dead cross will be the lagging, the most lagging, okay? It will be the most lagging. But it's the confirmation. It's the confirmation. It's the real final confirmation. It's bearish, really bearish for long term. You see, after that, very big long-term correction. And also about golden cross and dead cross here, I want to mention a bit. The most effective golden cross and dead cross would be the two lines, two moving average lines, direction same. What I mean, you see, when we have the white line, the yellow line downward cross the white line here, right? So we see both two lines, direction already obviously down, right? So this is the most effective dead cross. And you see, when we have the dead cross, obviously the white line already downward and the yellow line downward. But sometimes you have the dead cross, it looks like this. The white line, the white line, the direction still upward like this, and the other, the yellow line, a downward cross, right? So this is not the most effective dead cross. The most effective dead cross would be the white line, the longer term moving average already turned, already downward, and also the shorter term moving average direction also downward. So this is the most effective type of dead cross. This is not the most effective one. You can also say this is the dead cross, but this is not the most effective one. And in the same logic for golden cross, it's the same. For previously the long-term, longer-term moving average downwards, and the shorter-term moving average, a upward cross like this. This is not the most effective type because the two direction not the same. The most effective type would be the longer-term moving average direction already up. This is the longer-term moving average, and then the shorter-term moving average direction also up. This kind of golden cross is the most effective or most powerful. For example, this is the case. We see the two moving averages. When we have the dead cross, they all downward, right? So after that, it's very forceful correction for very long time here. But in sharp contrast, if I show you another period, so this is what we have checked, right? But if we check this time, this period, that's when we have the price in medium term to long term sideways. Okay, sideways. And you will see very clearly. We also have the yellow line downward cross the white line, right? So we say this is a dead cross, but you will realize that the white line, the direction is still upward. It's still upward. So means this dead cross may not be that effective or that powerful. Then we see after that, yes, the price is just sideways, and then finally, the price managed to stand above the two moving average again. It's not the same as the previous time we have the dead cross. The previous time we have the dead cross, the white line downward. And it's the same for golden cross, right? It's the same for golden cross. When we have the golden cross here, you realize that the white line still downward. The yellow line, although it break up or it cross the white line, we say this is the golden cross, right? No problem. But this is not the most effective type because the white line still downward. But you see here, this time we have the golden cross. Obviously, the white line upward. Sorry. This is this is the dead cross. Sorry, this is the dead cross. This is the golden cross, right? So you see, obviously here, when we have the golden cross here, the two lines direction all upward. This is the most effective golden cross. Of course, this golden cross, when it happened, the price already in a rally for a while, right? The price already hit a new high because we are checking the super long-term moving average. The golden cross is lagging, it's extremely lagging, but it's the final confirmation. It's a super long-term bullish now. You see the golden cross here. That's the most powerful one because all two lines upward. Then the shorter term moving average upward cross the longer term moving average. This is the most powerful golden cross. This is now the most powerful dead cross. This is now the most powerful golden cross. Previously, before the sideways period here, this is the powerful dead cross because all two lines downward. And this is the powerful golden cross because all two lines upward when the cross happened. This is some details about golden cross and dead cross. And also, I want to share with you the band, right? The fluctuation band. You see the band, it works for many times in the history. And I can show you some other examples because we don't have too much time to talk too many details. So I'll just go back to the slide to show you some of other cases in the slide. Okay, so where was it? The slide. Yes, just now we were talking about Microsoft, the fluctuation band, right? To avoid the false breakthroughs. Okay, another case is for Apple. For Apple, I have set 270 days and 135 days moving average for long term. We also have the fluctuation band. You see the price used to drop below the shorter term moving average, and sometimes it can hold, but in the end, the band can hold, the white line can hold. And then when it effectively drop below, then you see the price in sideways or in consolidation for a while, right? Before the price finally can give us the golden cross again here. The golden cross, this one is the powerful one, effective one, because all two lines upward, right? When the cross happen. The dead cross here is not the most effective one because the white line here still upward. It's not downward. If the white line here downward, then the cross happen. That's a more powerful dead cross. Okay. Yes, this fluctuation band, if you set it, then you can avoid selling here, but you can sell here, right? And you can also avoid selling here because it drop below for 1 day, quickly go back above the white line, regarded as a false breakthrough of the white line. The fluctuation band can hold. Okay, so this is another one for Amazon. For Amazon, yes, I have set it as a more complicated model. 255 days and 300 days for super long term, 144 and 170 days for long term, super long term and long term. Okay, so you see the fluctuation band for super long term here. It can hold, false breakthrough, it can always hold. And then for long term, the blue and the yellow line also can hold. See, can hold. This is the complicated part, right? We have the price in consolidation between the long-term band and super long-term band. The long-term and the space between the long-term band and super long-term band also hold, right? Yes, this is for Amazon. You can do it yourself, but it may be quite time consuming. But if you are the one who is very keen on studying on moving average, maybe you want to do it. But if you are not that type, you just need to know it, the knowledge and how it works. Yes, that's good enough. Okay, so the second solution to the problem about false breakthrough is you can combine with a trend line. Previous sessions we already learned a trend line, right? So if you combine with trend line, for example, this is Google alphabetic. For Google, this white line is 170 days moving average. For many times, this moving average can hold. It's an effective long-term moving average, but still you see sometimes the price is drop below, but it didn't give us really big corrections for long-term corrections. Then how to solve the false breakthrough problem here? Here, you draw the uptrend line, you combine. Then if the price drop below the white line, the moving average, but if the uptrend line can hold, you still can, yes, wait and see, right? And you only need to consider the sell when the price is drop below the white line and also drop below the trend, the super long-term uptrend line here. For example, like here, it drop below the white line and the moving average white line, and then also the uptrend line. And then next time when you see the price try to break up the uptrend line here, resistance, it drop again, and in future still would be resistance. Although we see the price managed to stand above the white line here again, but as long as the price unable to break up the uptrend line here, maybe it's not confirmed effective. Let's say it's not confirmed can be a long-term uptrend again. So I can do it in the software for you to see the effect. The white line here is 170 days moving average. So you got problems? I saw someone typing in the chat room. the NOS, they said the NOS of moving average different. Yeah. Later, the last part I will share with you how to find the best parameter for the moving average. I will talk about it the last part. Okay. Yes. So let me show you the effect for Google Alphabet by here. Yes, for the combination of the uptrend line and the moving average 170 days. I will switch back to the software. Later, I also will talk about Homely Rainbow. Okay, so let me go to the software first. Now I just want one moving average, right? So I will go to the setting again. I want to conceal the yellow line, just want the white line here. The parameter 170 days. Save. Okay, I changed to Google. And you see that the 170 days moving average for Microsoft, roughly, if you check the effect, also useful, right? You can do the study yourself. Like, yes, I don't have enough time to do all the studies for you. You can, yes, do it yourself. And then we go to Google, Google alphabetic. Okay, so this is the super long-term moving average. And if you check for this one, you draw a super long-term uptrend line, can do, right? Low points, significant low points. I want to connect this low and let's see this low. Roughly you check if I connect it this way. Yes, this uptrend line here, it also work for a very long time in future, right? I try to connect this low and this low. Of course, the angle you can adjust a bit. You can adjust a bit, okay? This low and this low. Okay, so then if I zoom in a bit, you realize that in my chart, because the slide is the last round, I talk about the 8 courses of technical analysis. That's the first half last year. That's the time when I conduct this series, the last time. So I have just used the slide previously. So that was, the timing was, yes, first half 2019. That's 2 years ago, right? Okay, so never mind. So can you see here? No, I think it should be roughly around here, 2019 April. This is the timing, the last time in the chart, in the slide. The last candle, I think should be around here or here. Let me check again. In the slide for Google. Where is it? I think it should be, yes, 2019 September. 2019 September. Okay, here should be roughly 2019 September. Okay, so we were there. Okay, so I think it should be around this point. Okay, here. This is the effective downward breakthrough of the 170 days moving average and also the uptrend line here, right? So next time we see, although the price is stand above the white line here, it touched the uptrend line, resistance drop to touch the support of the 170 days moving average. some sort of support. And if the price go back above the 170 days, then we know the price will fluctuate within the moving average and the uptrend line. So here we have the uptrend line and the moving average form a fluctuation band, right? So just now I mentioned the solution for first breakthrough. First one is you set the two moving averages to form a fluctuation band. But for this case, you see, interestingly, we got an uptrend line and a moving average line to form the fluctuation band. And then you see the price reach the uptrend line again, resistance drop again. Of course, it dropped below, right, the white line, and then go back again. So next time you expect the price touch and then drop to touch support, turn upward, and then resistance. That's until now. I think this is already until now, right? So yes, this is also a problem, also a method for us to solve the let's say false breakthrough problem. Of course, it didn't solve the problem completely. Let's say here, right? Maybe you can set a longer term, even longer term moving average, a bigger parameter than 170 days. Then how to set it? Here, let me share with you how to set a proper parameter for the moving average for different stocks. Now you want to pay 120% of your concentration attention here, okay? You go to window 2, okay? You go to window 2, you want to change the indicator in the second window to moving average group 1, same as in the first window, okay? You double click in the second window, double click in the second window, MAG1, right? Space, enter, yes. This is how we can quickly put moving average group 1 in the second window, because I just now set the conditions for moving average group 1. I concealed the other 3 colors of lines. I just remain the white line, and already I changed the parameter as 170 days, right? But we realized that for some cases, still we cannot catch, right? Some points we still cannot catch. This white line failed to catch some points. Then if we want to catch these points, maybe we can set a longer, even longer term moving average. How to do it? Because I feel this white line also useful, right? I want to keep it. I want to add one extra moving average. So I will go to setting again. I will, let's say, get one more line, the yellow. I will take yellow and I will click display. Then the parameter doesn't matter because later we will adjust to find the best parameter. I will just leave it as what it is. Okay, I save and then I click OK. Okay, so now we see 2 lines. The white line is the one we already set. We want it. But we want to set another parameter for the yellow line, super long term, longer even than the white line. How do I change the parameter for the yellow line so that it's the best parameter? I want the white line, the yellow line to maybe to touch this, to touch this, touch this, touch this. How to do it? We need one function called parameter adjuster. Where is it? At the bottom, okay, can you see the two icons here? I put a cursor on here. It tells you parameter adjuster. And this is also parameter adjuster. We have 2 icons here. They are the parameter adjuster. These 2 icons can help us adjust the parameter for the 2 lines, for the moving average lines. So if you want to adjust the parameter for the yellow line here, right, you need to double click in the at the yellow line here. The yellow line move MA yellow color, right? And then in the bracket, you double click in the bracket. You double click, then you can click the parameter adjuster. The first bar is to make the value bigger. If I click the first bar, you will see can you see the value in the bracket? It changed to 201, right? If I continue clicking, then you see the number become bigger and bigger. This is how we can adjust the parameter until you feel that it's the best effect. When you adjust, you see in the first window, the yellow line is changing, right? It's changing. Pay attention to the first window, the yellow line here. When I keep pricing parameter adjuster to add a value for the yellow line, changing to 200 and until 241, and then you see the yellow line, it's shifting. It's shifting. I want to keep until, let's say, the yellow line a touch which number touch the low point here. Okay, then you also see this time it also touch, right? And then this time it didn't touch, but you see here resistance. And how about next time? Next time, no. But you can, if you want to make it a bigger parameter until maybe the yellow line can touch this low, maybe you can continue pricing until the yellow line can keep shifting until it's quite a big number, until, let's say, the yellow line can touch if I keep moving. So you see the yellow line here become far away from the low point here, right? Because we are setting a bigger parameter, bigger number, bigger value here. So until, let's say, keep adjusting until, yes, now we are very close to the low point here, all right? Yes, but the value has been quite big. So I think normally we don't see so big parameter for moving average. Now it's already more than 400. It's already above 50. So now it's 472, right? If I make a wrong number, I use this decrease, make the value as 470 days, okay? 470 days, and we see the yellow line, it touch this low point. And you can regard it as a false breakthrough. And roughly here, false breakthrough. But for this, you cannot catch, all right? But if you want to know how effective this line is, you can check the history to verify. But I don't think we have, it's already the super long-term performance, right? So until now, we see the price, it just touched the yellow line for these 2 times. So we are not sure how effective this parameter can be for the yellow line here. And maybe just now when the price touch this low point here, that parameter maybe would be a better choice. I think that's when the parameter, how much is that? If you want to, yes, you can decrease. Now you can decrease because you feel that 470, that value may not be that useful, right? Because in the very long time history, the price it didn't touch that point or that moving average for many times. The more times the price touch the moving average, the more significant or more valuable the moving average. If I keep decreasing the value, then yes, now we see the yellow line, it touched this low point again. And we realize the value is around 300. If I make it a round number, I keep decreasing, make it 300, right? So 3 days moving average, you can catch this low point, and also it worked here, right? It worked also, it also worked here. And also it worked here. And we say this, we got some support here and support here. So if you check the yellow line here can be useful in future if there is very big, super big correction for Google. If it touch the yellow line, we can expect that it also can be useful in future, right? Yes, this is how we can find the best parameter for our individual stock. So you can do it for your own individual stock. Now we're checking the super long term. Maybe you're not really concerned about the super long term performance. You want to check a shorter term performance. For example, you want the moving average, it touch this low, this low, or this low. That would be a shorter term moving average, right? Then you can also use the parameter adjuster to find what value would be the best so that the moving average can touch the most of the low points for medium term, right? For medium term. Yes, you can try it yourself to see the effect so that you will find the best parameter for your own individual stock. Okay, so let me switch back to the slide. Oh, I need to speed up. Okay. Okay, so yes, and then how to reconcile the contradiction between hysteresis and stability? Just now we say if the moving average, you set the parameter as a very big value, it's quite lagging, right? It will be quite stable, but it will be quite lagging. So there is a contradiction between speed and stability. So how do we reconcile? Actually, you can just check Homely Rainbow. And also just now, people asked me about the difference between the moving average and Homely Rainbow, right? Okay, so here is the advantage of Homely Rainbow. So Homely Rainbow is much more powerful than the normal moving average because it's not just about moving average price. It also incorporates volume, time, and space. So with Rainbow, you can check for both long-term, medium-term, and short-term. The white lines, that's for long-term, the yellow line for medium-term, the blue in between the medium term and long term, and the red and the green for short term, right? And then why we say rainbow would be the ultimate solution, because it will save you the trouble to adjust the parameter for your stocks. Just now I showed you how to use the parameter adjuster to find the best parameter for your moving average, right? But for many people, many members, I believe you will find it quite troublesome to do, very time consuming to do it. We don't want to do it, right? If you don't want to do it, it's okay, it's all right, because Homely software provide you the Homely Rainbow. Rainbow is a very powerful indicator. For long term, you check Rainbow, it is good enough. The parameter already been adjusted to the best. You don't need to study what parameter is the best. Homely Rainbow, it is the best parameter. Okay, so JD.com. You see we say yellow lines is very practical, especially for medium-term to long-term investors, right? So for swing trading, yellow line important to check. If the price effectively drop below the yellow lines, we say medium-term sell points. Let's say for here, it hold, so no need to sell. But here, obviously, below the yellow line more than 3 days, you sell. Then that's a significant correction here. And here, a drop below the yellow line again, and sell point again. And then after that, you see the price drop below the white lines. If the price drop below the white lines means what? Long-term bearish reversal. Although we see the price, it tried to break up the white lines again. It's a fourth break up because the white lines already changed direction from upward to flight. Remember what we have learned for ground wheel trading rules? Also can apply it in the Homilychart rainbow. When you see the white lines going flat already, most likely is reversing to long-term bearish. When you see the price, even it break up the white line again, if it cannot stay above it, quickly drop below, confirmation, long-term bearish reversal. And yes, here is when the price drop below the yellow lines means, wow, long-term is already bearish. For medium term, also bearish, just a drop. And here we have the white lines here, change direction from downward to flight. And when you see the white lines going flight, the price successfully break up the white lines. We see both of dark horse, long-term bullish reversal. This is the reversal buy if you are checking the ground wheel trading rules, right? The 8 trading principles. This is the long-term reversal. Here, we also have the price break up the white line, but it's still downward. It doesn't count. We need the white lines going flat, right? After the reversal, we see the price, it drop, but the white line, the blue line here act as very strong support. The support hold, it go upward again, means it's still okay. And the white lines hold again for the second time and for a third time. So white lines, you check it for long-term performance, it's the best parameter already set for you, because we have 4 lines to form a band, fluctuation band. Remember, I told you the solution for false breakthrough. Solution 1 is you set 2 moving average, 2 different moving average form a fluctuation band. So for rainbow, I already set for you. The first, the area, the space between the first and the last blue line, that's the fluctuation band. Also, the first and the last yellow line would be the fluctuation band, right? Okay, so I think this is more or less what I want you to learn after this moving average session today. Hope it can be instructive for you. And if you still got some questions, maybe you can ask after the session. But today I don't have time saved for you for question and answer, for asking questions. Okay, so I think that's all for today because it's already 9. So I will call it a day for today and wish you, let's say, a very good beginning for your stock investment in the new year. Okay, so I will see you next Tuesday. Bye-bye.